You want to save money on your taxes? If so, there's an important tax rule that you're going to need to understand called the step up in basis. With the right understanding and usage of the step up in basis rules, you and your heirs could significantly reduce the amount of capital gains taxes you're going to have to pay. And in this video, I'm going to cover everything that you need to know about this step up in basis rules and how to use it strategically to save money on your estate taxes. If you're new here, I'm Dr. Jeff Anzalone, a periodontist. I'm not an estate planning attorney, I'm not a financial advisor, and I'm not a CPA. Check with yours before you apply any of this information. And do me a favor, download the free passive income guide with the link that I've put below this video. Let's start off by answering the question, what exactly is the step up in basis at death? Now, the step up in basis is a tax provision that actually adjusts the value or the cost basis of an inherited asset. This could be like stocks, bonds, mutual funds, real estate, etc., when passed on after the original owner's death. Now, the cost basis refers to the original price of an item before its value increases over time. Now, when you sell assets that have increased in value, you must pay capital gains taxes on that profit, which is the difference between the current value and the original purchase price. When an individual inherits property, the step up in basis rules adjust this inherited asset's value to conform to its FMV, or fair market value, for tax purposes upon the descendant's death. The property's value immediately before the descendant's death is treated as income for tax purposes. This rule is beneficial because it actually reduces the capital gains tax burden on the inherited property. However, suppose that the inherited asset is actually sold later after it's received and its value has increased since it was inherited. In that case, the new owner will need to actually pay some taxes, but the tax will be on the increase in value from the time it was inherited, not from the time when it was originally purchased. Let's use an example to basically drive this home. So for instance, imagine that your uncle gives you a house in his will, and he originally bought the house for $100,000. So by the time your uncle passes away, the house is now worth $250,000. Thanks to the step up in basis rules, the original price of the house is actually considered the same as the value when your uncle passed away, or $250,000. So if you decide to sell the house at its current market price, $250,000, guess what? You're not going to have to pay any capital gains taxes. This is because, as far as taxes are concerned, you haven't made a profit. So now that I've mentioned a little bit about capital gains taxes a few times, so let's actually discuss this. What exactly is capital gains tax? Capital gain, again, is the profit that you make when you sell an asset for a higher price than you originally paid. The formula is this: capital gain is the selling price minus the purchase price, okay? The government, the good old government, doesn't only tax your income now while you're working, but it also wants a portion of your investment profits too. This is what we call capital gains tax. And according to the IRS.gov website, nearly everything that you own and use for personal or investment reasons is considered a capital asset. This could be things like your house, personal items like furniture, and even investments like stocks and bonds. Now, if you sell the asset for more than you paid after any adjustments, again, you've made a capital gain. Capital gain, you sell the asset for more than you paid, that's called a capital gain. On the other hand, if you sell an asset for less than you paid for it, then it's actually called a capital loss. So let me give you a very, very simplistic example. Suppose you bought a stock for $5, all right? You held that stock for 3 years. So in 3 years, you decide to sell it. That stock has actually doubled in value. So over 3 years, it's doubled to $10. So the difference between the purchase and the selling price is $5, okay? That's your capital gain. Now, the length of time that you hold on to the asset is something else that's going to affect your capital gains tax rate. Now, you're going to be taxed at the short-term capital gains when you hold the asset for less than a year. And the short-term capital gains tax typically is taxed at your ordinary income level, which is going to be the highest one. Now, in this example that we just used about the stock, because we held on for 3 years, we're going to pay the long-term capital gains. So if you hold it for more than a year, you pay long-term capital gains, which is much lower. It could be 0, 15, or 20%, depending on your tax bracket. Now, the step up in basis can be especially beneficial for investments that actually have appreciated considerably over time. So for example, let's say somebody inherits a $50,000 stock portfolio with the original cost basis of $50,000. Okay. So now when the person passes away, the fair market value at death is going to be $200,000. All right. Now, let's say that we hold on for this for a little bit and it actually goes up and we decide to sell it for $250,000. Okay. So think about it like this: taxable capital gain is calculated as follows. So we have the sales price of $250,000. Remember, the stepped up in basis was $200,000. So the difference between the two is $50,000. All right. So that is actually what you're taxed on. So without the step up in basis, the basically the tax liability would be calculated on the original cost basis, resulting in a higher capital gains. Now, what about federal estate taxes? One of the primary goals of the step up in basis is to eliminate the potential for double taxation. This is achieved by focusing on federal estate taxes rather than capital gains taxes. So when a person dies, their estate may be subject to estate taxes if the total value of assets, including appreciated securities and real estate, exceeds the estate tax exemption, which in 2023, let's see if we've gotten written up here. We do not have it written up there, but in 2023, as of the time of this recording, it's roughly $12 million per individual. Okay, so the state tax exemption is $12 million per individual. Now, the step up in basis ensures that taxes are levied at the estate level rather than at the individual level when inherited assets are ultimately sold. So while beneficiaries still need to be very mindful of potential capital gains taxes resulting from the eventual sale of inherited assets, the step up in basis can provide significant tax savings, particularly for these really highly appreciated assets. So let's briefly talk a little bit about some of the more popular estate planning strategies. More than likely, you've probably heard of the first one. It's a trust. So this is probably one of the most common. So trusts actually, they allow individuals to transfer assets into a separate legal entity. And this separate legal entity is actually managed by a trustee. So for example, revocable trust, they offer the flexibility of allowing for the transfer of assets while still maintaining control during the person's lifetime. So while you're still living, if you need to change anything or whatever, it's revocable, you can do that. Now, upon the individual's death, their assets held in the trust, now they're going to receive a step up in basis, generally equal to the asset's fair market value, remember, at the time of their death. So this, remember, is going to help minimize capital gains taxes when their beneficiaries eventually sell these assets. Let's talk about another estate planning strategy, and that is actually the gift tax exemption. Now, the IRS allows individuals to gift a certain amount of assets each year without incurring any gift tax liability. As of this year, 2023, the annual exclusion for gift tax is $15,000 per recipient. Additionally, a lifetime gift tax exclusion of $12 million allows individuals to transfer larger amounts without actually incurring any gift taxes. Now, it's important to note that gifted assets will not receive a step up in basis at death. Therefore, when selling the assets, beneficiaries will inherit the original cost basis of gifted assets, potentially causing them to incur some capital gains taxes. Now, this is a question that comes up quite a bit. What about if you actually inherit any type of retirement accounts? What goes on with that? So 401ks, IRAs, pensions, those are actually treated differently than other assets in the context of step up in basis rules. So beneficiaries of these types of accounts do not receive step up basis on those inherited funds. Instead, the distributions from these retirement accounts are generally considered income, and the beneficiaries may owe income taxes on the funds as they withdraw them. Factors affecting the tax implications of these accounts include the type of account it is, the beneficiary's age, and then the chosen distribution method. So, for instance, IRA. So, when you inherit an IRA, the beneficiary may be subject to RMDs, or required minimum distributions, which actually must be taken out and taxed. Similar to inherited IRAs or 401k. So, the beneficiary may be required to take RMDs from a 401k and pay the taxes on the withdrawn amounts. And then pensions. So, in some cases, a surviving spouse actually may be eligible to continue receiving pension payments, which would be treated as taxable income. So now you should understand that the step up in basis is a crucial tax provision that actually adjusts the value of an inherited asset to its fair market value at the time of inheritance. Now, remember, this adjustment can significantly reduce the capital gains tax burden on the recipient, as it basically simply just resets the asset's cost basis. Now, if you want to learn more about saving money, who doesn't, regarding taxes, do me a favor, check out this video.